Hi, good day, everybody. I trust you are all well. Um, Hi, everybody. I trust you are all well, and welcome to this week's broadcast. I sincerely hope you've had a great time trading. So, when we start off, the usual thing that we got to do is the weekly setup. And I think as a 5-minute trader, a 5-minute chart trader, if you are following me, you will start to get used to how I look at the charts. This daily setup that you're going to do each and every day is absolutely critical if you're going to get the results that we want to get. So, three currency pairs that we are trading off the 5-minute chart. We've got the euro, so it's a euro dollar, euro to the dollar. We've got the Canadian, USD CAD, and yen, USD yen. So as I go through, when I just say euro, CAD, or yen, please bear in mind I'm trading the majors, and that's what I'm referring to. So I'm not trading any of the crosses. So when we kick off each day, there's a few lines that are on the chart here. I'm going to get to that today. But the most important thing that we want to look at is always go in on the daily chart and see what is transpiring and what is happening. Now, if you've been following for the past couple of weeks, you will know what the setup looks like. Let me just do this for you pretty quickly so you can see what we're talking about. So that's the daily chart of the euro. If this is the first time following me on this, where you actually have to start is on the monthly time frame. It looks a bit messy at the moment, but at the monthly time frame, I usually look at that at the beginning of the month just to see if there are any key levels of support or resistance that I need to watch out for that are coming into close view on my daily time frame. Because if they're coming onto view on my daily time frame, that's the thing that I really want to trade. So on the monthly time frame, we're into the second week, so nothing to worry about at the moment. We're at that low of the previous month, which I would have marked and indicated. So I'm going to leave that for now, and let's go to the daily time frame. And what we do on the daily, always need to have a look first at what happened yesterday. What was the high of yesterday, and what was the low of yesterday. And the high of yesterday, 1.19155. What I do is just come down to the 5-minute time frame. This one that I'm trading at, and you can see that green line there. That green horizontal line represents the high of yesterday, 1.19155. So I mark it there, very significant. The high of yesterday and the low of yesterday are extremely significant because those are the primary levels that are going to affect my intraday trading. Go back to the daily again, you can just pick up the low of the day, the low of yesterday, which was 1.18354, and again you find that in the mark that with the red horizontal line. That's where it is. Then the other thing that I want to pick up of the daily is the open of today. Okay, 1.18993. Then I just come and plonk that, which is that purple or magenta line, depend how you are viewing it or seeing it on your screen. So that open is important. So those are three things that I need to mark. Then what I do is I start to trade. Today I was in the market quite early. I traded the Asian session as well, and I'll talk about the trades that I took as we go through. But I want to mark the beginning of each session, and my indicators for each session is the open and the Asian session open of Tokyo Stock Exchange, which for me is 2 a.m. my time, because I'm South African GMT +2. And I've also just marked here the open of the European session, which is at 10 o'clock my time, 8 o'clock GMT. Now, what you notice, what I've marked here is 9:55. It's just 5 minutes before the open. Kind of just mark it. I want to see what happens with the first bar that has taken place of the day, and then based on that, I can just start to get a view of what's happened in the prior session, with the opening with the first bar of the day. Then the other thing that if you trade the 5-minute chart, you want to mark where the session reaches the 18th candle. That's an hour and a half into the session, which is this gray dotted line, because at that time, after 18 bars, the market typically has put in either the low of the day or the high of the low of the session, rather, or the high of the session, which just has to frame your thinking when patterns set up. If you think a pattern is set up, you want to go short, and the high of the day is in them, kind of encourages you to hold your trade much longer. Alternatively, if you want to go long and the low is in, then hold your trade for as long as possible during that particular session. So what we've done on the euro, the same thing that you repeat on any time frame that you're trading. And for me, I am trading these three. This way, on any chart you're trading, I'm trading the CAD. So again, I would have gone in and said, what's the high of yesterday, which is 26855, and I'll just simply come back or come down rather to my trading time frame and make sure I've got that point in there, so that when it comes into view, I can see it clearly, because I don't want to be surprised by price reacting to that level of resistance or support without me being aware of it. Then the other thing that we track, of course, is the low of the day. Again, you just pick it up. What's the low of the day? The low of yesterday, 25902, something. Low of the day, red line, which is indicates for me that's what I need to observe when I take down there. Then I pick up the open of the day. What you'll find when I trade the Asian session, as I did this morning, I don't come in straight on switch over at midnight. I come in into the market about 15 minutes before the Tokyo Exchange opened, before 1:45, so at 1:45 midnight if you on GMT. And then I look at where the open has been and I track that. So the open here, 1.26339, we would have that marked there. So those are my 3 key levels. And then again, I mark just 5 minutes before the open of the Tokyo Stock Exchange, 5 minutes before the open of the European session. And if I'm still in the market, which I'm going to be when the US session opens, it opens at 4:30 my time, 2:30 GMT, or just 5 minutes before in the market. Because the open of a session is of any session is subject to a lot of price movement. So falls, breaks, breakouts, whatever the case may be. And I treat it just as I would treat any red news. If there is red news on Forex Factory, I want to be aware when that red news is coming in. If I'm already in a trade, I just make sure my stop is at the proper technical level. And if I get stopped out, that's fine. If not, well, we'll stay in the trade. But if I'm not in a trade by the time the news comes within 15 to 30 minutes, I'm not going to initiate any trade. Similarly, if I'm not in any trade, at the open, I'm just going to wait and see what we get. If I'm in trades, then I just keep my stop at the correct technical position. The same thing in terms of daily setup, we will do again on the currency pair, the yen. You just go previous day, what was the high, 109,233, and you see that I've put that in there, 109,233, that green line. Low of yesterday, 108,414, again, you'll find that's already in there. And then the open of the day, 108,461, 108,461, that would be in there. Then, of course, like I said, you mark the open of each session and start to observe how price is moving at the different times of each session. Whatever you are trading, doesn't really matter. So, I mean, the Asian session, for me, if I got the energy to get up at 2 a.m., quarter to 2 and be in the market, I get up and trade it. And the reason I do that is because I like to trade the first part of the Tokyo Stock Exchange, 2.5 hours up to 4:30 my time. Then at that time, the day is starting, I get up, go and exercise, take the kids to school, and get to the office, etc. So I don't really worry about the second session. In fact, managed to get trades, fantastic. If I haven't got trades, that's all fine as well. Then, during the day, I just keep my charts open at each session, keep a glance, and make sure I want to make sure at the actual open of the European session, I'm actively active in the market. The open of the US session, I'm active in the market as well. If I'm doing other things, I don't worry about it. I mean, sometimes you come back and the market is moved, and then you're working on something else, another project. That's perfectly fine. There is plenty of opportunities in the market. A day could go by when you haven't had the chance to work, to trade the market. So if that takes place, I just do not worry about it. Now, what we're going to do, this show is an hour. Let's have a look at what's currently happening in the European session. And let's see if anything is setting up for us that we might want to take as a trade. Then we'll look at all three charts, Euro, CAD, and the Yen. Then I want to just go back and show you some of the trades that I took in the Asian session, which turned out quite well. I'm trading 1%. I'm up 6% on the day. So I want to show you those trades. So you can see the rationale and thinking that I went through. So just where we are now with the yen. Let me just have a quick look at the question that's broken up. What is the time offset between your local time and your MT4 saver? So it's spot on. MT4 right now is 11:40. My time is 11:43. So for my time, it is exactly spot on. Now I'm GMT +2. But good question. I'll keep checking out just now. So yen. Here's what's happening with the yen. Currently, we came and tested this low here. And this low was a double bottom with the previous higher low in the Asian session. Market tried to break beneath that and failed. So I see that as a double bottom. But when I see a double bottom, I don't trade off the double bottom itself. I have to wait for a pullback off the double bottom. Then I want to see at least two-legged move. So today, at some point, I'm going to be talking to you about two-legged moves and just how critical they are in terms of how we take trades. Last week, we spoke about measured moves. So today, we'll talk about two-legged moves, how the market moves, pullback, and moves equidistant after a pullback. That's something that's very useful, and I'll show you how the trade that I took will help me to take profits before the market turned. So you need to be aware of that. So at the present moment, I want to see what's going to happen here. So there is my double bottom. There is a pullback of it. Market tried to resume again, and it's failed. I want to see what kind of a test we get off the moving average, and then see, if I get a high low double bottom somewhere within here to give us an entry to go long. So that's where we are with the yen. Canadian USD CAD is looking almost a similar kind of setup. Squeeze it out a bit and I'll open it up. So last week we spoke of measured moves. So here's what happened. So just before the open, so the open was this candle here, the bullish candle. So my purple dotted line, which indicates opening 5 minutes before that. The market went up at the open and immediately reversed to come back and test that. Now, when you see that kind of trading range, now we know that if the market breaks beneath any form of trading range, it will most of the time target a measured move, the height of the trading range that is breaking out of. So let me just delete it and I can plonk it back for you. So I use that tool there. So from there, I want to make sure my 50% is at the low of that. So there's the top, there's the bottom. The extension will be here. Okay. So if for any reason we're taking a trade in here and I didn't have a setup at the open to take that trade, if we're taking any trade, you want to take your profits in this zone here, which is almost at that double bottom with our previous high and low. And you can see what's happening here. A lot of this is or some of it, a big portion of it is profit taking from bears who initiated trades all the way down here. But also bulls want to create a firm double top. So now we are also at a double bottom, but we need to wait for clarity to emerge. Why do I say we need to wait for clarity to emerge, and why is there no clarity at the present moment? Because what you want to see is clear moves. We could start to count now and say, okay, double bottom. The bulls wanted the double bottom to hold. The bears resumed, but they failed. Bulls resumed again. So that's another attempt by the bulls, that little break above that. But it failed. Bears tried to resume, tried to break beneath this. They failed. Bulls resumed, tried to resume again, then it failed, then there's another resumption. Each of these moves is pretty significant, but because it's happening consecutively, one after the other, goes up, goes down, this is a tight trading range. You don't need to do anything in a tight trading range. Wait for the market to break out either way and give you a retest of some sort so you can trade. So, and how far could the market go? I'm just going to move that 18th line out, because we have a tight trading range that's forming. Again, you've got to be constantly saying to yourself, if the market breaks out of that tight trading range, how far is it likely to go? So if it breaks below, this is how far the market may go. So this line here was the 18th candle, so we might have a low already, a high of the day, or a low might be forming. So I'm just going to delete it so that our pictures remain clear. On the other hand, if the market breaks above that, how far is it likely to go? Okay. Now, what will it mean? If the market breaks above this trading range, we are coming to test whatever breakout we had here. Okay. Which would, for me, it would mean that I gotta keep looking. I gotta look for shorts, because if the market tests that and creates a double top, then chances are it will come back quite forcefully. Possibly bear breakout and carry on a bit lower. So again, let's wait and see what happens with that breakout. What I used to do, which you can do in the earlier days, just to keep a visual of what's happening as a reminder. You could do that. Just put a different colored zone for yourself there. So you just kind of know when you flip through, especially if you got multiple charts looking at, you've got to wait for that breakthrough out of that. Let's have a look at the euro, what's happening in this session. So what happened with the euro, I'll talk about this trade that I took earlier on. So the open of the session. Now you always have to be very careful at the open of the session. You know, there's three things that could happen. You could get immediately a trend starting from the open of the session. And when that happens in the form of a breakout, your mind's got to be thinking, okay, do I have a confirmed breakout? In other words, do I have a breakout candle with a follow through? So if we have a look here, the market opened, we had a bear candle, we had a bear candle follow through. Now, you know, at that point we say, okay, maybe there's a breakout, but look at that tail, that's a problem. Then immediately following that, we have a bull doji, so there's no bear breakout, the bears have failed. The market turned with a strong bull candle. Again, no setups for us to trade at this stage. Then we have this bull candle. Now, this bull candle is the actual breakout candle that I would consider is breaking above that high and that trading range that opened at the beginning of the session. But what I would have loved to see, for me to have gone to take a pullback trade, you know, whenever you see a breakout, you want to see a follow through. So I didn't get a follow through, so no trades to take at the open at this stage. But yes, the bulls are strong. So what I want to see is what kind of pullback we get. So they came to test the open. Remember the open that we had, open of the day, almost near the high of the day as well. And now we're having a pullback that's forming. And again, at this stage, 18th bar, which is pretty key on 5-minute time frame, we might have the low of the day already in front. But we got to wait and see what kind of price action we get. Now, while we do that waiting, I'm going to talk to you today about leg 1, leg 2 extensions. But before we do that, I want to give you a visual of the trade that I took earlier on in the Asian session. Okay, so here's what happened. When I came into the market right here, so it's 1:55, 5 minutes before the open of the Tokyo Exchange, I saw that that bear candle. Okay, so it's breaking out beneath that, and I wanted to see a follow-through bear candle. There was a follow-through. That looks small, but this is enough follow-through, closing beneath the low previous candle and closing near its low and selling to the close. Then we had follow through, you know, but I'm waiting for a pullback to trade. So the pullback that I wait for after seeing this breakout is a pullback to the EMA. Now you see I have the solid blue line is my 20 EMA, that's my primary trading line, but I also have put in for instruction purposes the 10 EMA because that's a dynamic trend line that shows me the pace, the strength of any breakout. So as long as the market bounces off that, I know the breakout is pretty strong. So I had that breakout and the 2-bar reversal. So I put my entry above that. It was testing the moving average. I had my stop right there. I was triggered in, and immediately I got stopped out. So I got stopped out there. By the way, you know, the trades are all here in the history. So there's a trade. I had two trades that I got stopped out, and then trading 1% in a $500 account. You know, that's almost 7% up for the day. So these are real trades fresh in the day. So, okay, I got stopped out now. Here's something I want to talk to you about. Whenever we take trades, there are things that are important. For me, I showed you before, you need to have your strategy. Whichever way you write your strategy out, this for me is these 2 pages is how I trade. My strategy is written down. All the scenarios I look at, and that just become automated. I look at it, I know that's where I should trade when I get tempted to jump into trade, because you can trade virtually every single bar. If you're a scalper, as soon as it turns short, always in short, you go short. If it turns always in long, you go long. But that's not how I trade. So I follow my strategy. Now, obviously, there are 3 things to bear in mind with the trader's equation. The risk that you place on a trade, you have to be comfortable with the risk that you trade. So depending where I am, my initial risk is always 1%. And after I've built up equity, I'm very comfortable to go higher, 2, 3%, etc. On subsequent trades, but always 1%. So like here, when I got stopped out, I got stopped out for 1%. So you control your risk, and you know where to take your reward, and that's where the leg 1, leg 2 is going to come in. I'll tell you where we can set a reward, and you need to have in your mind that at least I want to make a 1-to-1 return, for example, and where you take that. But if you know how to read price action, 1-to-1 may not be the optimal trade that you go for. It could be 2-to-1, 3-to-1, 4-to-1, whatever the case may be. If you take in major trend reversals, which I talk about at some time, we're aiming to get 3-to-1, 4-to-1 trades if the market moves in that direction. So you manage your risk, manage your reward. The other thing is probability. Now, probability is based on the setup. When I'm taking trades in my strategy, 4 of my strategies typically 60% probability in my favor, 60-40. 40% of the times I'll lose. Out of 10 positions that I put in trade that I take, I can lose 4 times out of 10. One of my strategies is a major trend reversal strategy. And on that one, I'm really looking to get 3-to-1, 4-to-1, 5-to-1 returns. But that's a 40 to 60. That's the inverse. Out of 10 trades, I will lose 4 out of 10. But that's the strategy. If I manage them well, my losses will be minimal, but the rewards when we move in that direction will be quite significant. Now, having said that, risk-reward probability, when you actually place a trade, there's something that you can't control, and it's simply called random distribution. What is going to happen with that particular trade, you don't know whether the 6 winners are coming straight away or the 4 losses are coming, or whatever distribution they may be. So always bear in mind, from the time that you place a trade, the moment you place a trade, you place your order in, random distribution comes in. So you can lose, which means you get stopped out. Don't make a fuss about it. As long as you've risked it and structured it correctly, you go again. So that's what happened here. In the morning, I got stopped out. But then I waited to see what would happen, because as long as the market didn't break out above this, my thesis for short was still valid. So I had this strong bull candle, and look what happened. No breakout confirmation. In other words, there was no follow-through candle, no follow-through bull candle to confirm that the bulls are strong and subsequent follow-through. We had a test of that initial bear breakout. And again, the bulls failed to close above that. We then had a resumption of the bear move. So beneath that, that's where I entered my trade and stopped above here. And as you can see, the market moved in my direction. Now, when I'm taking that kind of trade, the first take profit level that I set is I look to my left. There is a trading range that we have here. Okay, and my first thought is, okay, if the bears are strong, they're gonna break beneath this, and depending on their strength, they're gonna want to go for a measured move. And where is the measured move from there to there? There is a measured move. So typically I set my first take profit there. And then when the market begins to move and I get my first pullback, so I had a breakout here from my trade. So there is a pattern that I was trading. I was trading a low two, so there is a double top, but I don't take that. I wait for the confirmation. There's a confirmation. Put my order beneath that, and then got triggered in. So I'm in the trade. Profit level is here, but now I'm waiting for a pullback. Okay, so the pullback comes. The first pullback bounces off the 10 EMA, and I put another order in the market here. Okay, up to this stage, my stop is still up here. I'm not touching my stop, so I put the order into the market at this particular stage. Then I have my stop above here. When this is triggered, I can then tighten my stop from the earlier trade, so I have some profit on that. And this comes back and hits me out of some profit, and then I should be able to get out break even. Now, the moment I have a pullback and it begins to go in the way of my direction, I'm now looking for a leg one, leg two move. Now, let me talk to you specifically about leg one, leg two extension. This you have to think of this and view it in conjunction with the measured moves that we spoke about last week. So, and the reason we're doing that, we want to see as many areas of confluence the price is likely to take, because that's where we take our profits, right? As many areas of confluence, that's where we will take our profits. So, what happened here? Okay, I'm gonna take off the tool I use for my leg one, leg two, so that I can explain. The market tends to move in two cycles. It moves in a direction. There is always a pullback, and then if it's going to keep on going in the direction that you're trading, there will be a second move. More often than not, higher probability is that the height of the first move will be equivalent to the height of the second move. So the first move is leg one, then we have a pullback, and then from the pullback we have the second move. It's almost similar to a measured move, except you have a pullback. When I take my measured move, when I have my measured move, so this will move from the top of here. Let me just put it back. When you have a measured move, you're just saying the height of the trading range. If you break below that, market may go down. Now your price is actually moving in your direction. The tool that I use is the Fibonacci Expansion. Okay, and I'll show you the parameters just now. You just plonk it at the top of where the move is starting. And what you want to take it down to is where the first move ends. And then you want to take the pullback to where the pullback begins. Okay, so there is the first leg and there is a pullback. And now I'm anticipating that this first leg after the pullback will be the same as the second leg. Leg one, pullback, leg two. Which means if I'm in any trade, I want to aim to take my profits here. Now I have two levels of support, hidden levels of support, and that's what I call them if I make reference to the hidden level of support, because you can't see it unless you actually plonk it in. So somewhere in between here, I'll be expecting to that's where I want to take my profit, because at that point, the market notices these levels of hidden support, and there will be some form of pullback. It may continue down, but at least I'll take my profits out. Let me just have a quick look at the question. The breakout follow through, meaning the next bar is as big as the breakout bar. No, the next bar does not have to be as big as the breakout bar. The next bar needs to be just a trend bar. So if you go in short, it needs to be a trend bar of whatever scale that breaks the low of the breakout bar. and closes on or near its low. So confirming that the bears are strong in that case. So here's an example. So we broke beneath the low of this. Now the next candle didn't have to be this big. It could have been as small as our entry signal, but as long as it's a trend bar that's confirming the move. If it's big, fantastic. If it's not, it doesn't matter, as long as it's confirming the move that we have. Now, let me just show you the properties I have on this Fibonacci expansion. All it is, it's just everything else is deleted. Just level 1 Fibonacci expansion 100.0. That's all that I use. Then you can decide whatever color you want. Visualization on all time frames. Always remove the ray because you don't want this thing shooting over. So that shows you. So now you can see exactly leg 1 pullback, leg 2 profit taking, which is also the same level as measured move. The other thing you could have put in as well, the height of this to the pullback, that little triangle is noticed as well. The market pays attention to that. Okay, so just going from the height of the pullback to the end of the trend. Okay, and you can see that's almost, so there's 3 levels where you ought to take your profit. Okay, so pretty clear example. I mean, as I said, I'm 7% up on the day, so I was stopped out there, but I stayed logical and calm and managed to take 2 additional trades. If you have a look at the Canadian, okay, I took trades in here as well. How do we get the buyers to go short for the euro? Okay, I presume let's just go back quickly. And let's blow it up a little bit. Okay, so remember, I came into the market, into the Asian session at 155, which is exactly the time on my MT4. And I marked, 5 minutes before, so I can see what happens with the first candle, the first session. There's a big bear candle, okay, and you could see this big bear candle broke beneath the lows that we had in the first couple of hours of the day, and then we had a follow through, closed beneath it almost. There's another a good example, doesn't it? A big candle closed beneath it. So I'm happy now that I have the bearish move on the open, but I'm not going to trade the breakout itself. I want to see a proper pullback. So if you look, even though the third candle of the open at a bull bar, it was still closing beneath this low. It didn't trade above this candle, and so for me, we're still bullish. If you trade above that and come to close on its low, then I'll be saying we have a dodge here, so we have a problem. Then we had a couple more bear candles, so I'm happy with this move as indicating bear strength. Now, what I want to see is just a pullback, and I'll trade the first reversal on the pullback because it's a strong breakout that's testing the 10 EMA. So that's the one that I took. Then I got stopped out, but even though I got stopped out, look at what happened with price action. It still didn't close above the original strong bear candle. Okay, then all I wanted now, so that's a double top. Now I'm trying to see from the pullback on the double top, can I get a decent enough signal close beneath the moving average to take the trade, which is why I took that particular trade. Let's check out. Do you trade every day, night, Friday? So because I'm in South Africa, which is GMT +2, the most logical time frame for me to trade, the one that I consistently trade is is the European session, right up to the first couple of hours of the US session. Now, I try at least three times a week to get up early. So sleep early, get up early so I can trade the Asian session. And I start trading when the Tokyo Exchange opens at 2 a.m. my time, GMT midnight. Because if you're able to identify moves at the open, there's some pretty decent, some very strong moves that can happen with low risk. I mean, like this morning, out of the trades that I took, I mean, it was a pretty reasonable morning. You know, despite being stopped out twice, I'm up 7% on the day without yet taking another trade. So if I get decent setups and I trade them, you know, it could end up being a very productive day. So it's just something that I manage for myself. Get to sleep early, put in 5 hours sleep, get up and trade. You know, if you can do that, if you can trade, maybe you can just trade the opens of the sessions, first 2-3 hours, that's fine. And go away, do something else, trade the open of the European session, open of the US session. Maybe you can trade the last 2 hours, the closes of the sessions. I mean, the market is always moving. You need to find what works for you. And then also the other thing is if you don't get to trade, don't worry about it. You know, I don't have to trade today. I don't have to trade tomorrow. You know, to have a good week. You know, I can trade Friday if that's the case. So manage yourself, manage your own psychology, and build it up from there. So I was having a look at the trades that I took off the Canadian. So just to show you quickly, I got stopped out of the euro and the CAD. Okay, those were talking about random distribution. Although I ended up like 7% up on the day, the first two trades, you know, I got stopped out. So on the CAD, you know, I saw, okay, so they, right from there, you know, when I came into the market had moved, there's a breakout, there's a follow-through candle, there's another follow-through candle, fantastic. I'm waiting for my pullback to trade, and then saw that pullback, decent 2-bar reversal off the 10 EMA, put the entry there, and stopped beneath here, and boom, a couple of bars later got stopped out. But, you know, you got to stay in the market. So when I looked at it, and I said, well, let's see if the bears are strong, they're going to put successive candles beneath the moving average and close the breakout gap here. Then we can start to look for shorts. But they didn't do that. You know, they had a close beneath moving average, and immediately we had a moving average gap bar. That's in a strong trend. The first candle that's beneath the moving average that's got a gap. That usually signifies that the trend will resume one more time before it reverses. So I had that closed above the moving average, and I said, well, I'm going to take the trade. So I put the order into the market, got triggered in on this candle, and have a look at this. This is a breakout candle because it closed above this, and we had a follow through. The follow through candle was not as large as the breakout candle, but it was a confirmation of breakout. So once you see that, even if you didn't take a trade deal, once you see breakout and confirmation, wait for your pullback, and because it's a breakout, put up the 10 EMA and wait for a test of it. So I was in that trade, but even if you hadn't taken that trade, there was a decent enough trade to put your order in, put the order in there. Put your stop a couple of pips beneath that, and once you get triggered and close above that, I move my stop to that same stop level. So if that has been stopped out, it's 1% off out of a bit of profit there. Now, again, talking of where do you take your profits? So initially, when I'm taking the trade, all I have is this here. All I have is that. So I have my measured move to say the price may want to get to there. So that's a nice place to put my initial take profit level. Then you know, when the market begins to move, talking about leg one equals leg two moves. Again, let me remove some of the stuff that I have here. Not needed. Okay. So now I have my breakout, and again I'm using the same Fibonacci expansion tool, and I'll delete it and show you again. So I just I've set it up, Fibonacci expansion tool. There is leg one, okay, and there is a pullback. So there is the top of the leg one. There is a pullback. So market went up to there, pulled back. So the height of that first leg is likely to be repeated on the second leg. Okay. So profit, the market is likely to get to there. So I've got to take my profits within that area. And that's where I took my profits on that. Leg one, leg two shows me the distance that the second leg is likely to go through. So if I haven't taken a trade, and the breakout trade is perfectly fine, because there will be an opportunity to take a trade with proper risk managed, proper profit taking, where you can make your money out of that. And I think that one was probably a 2-to-1 trade, just there on its own. So if you had missed that, and you wait for that, that's why you need to define your strategy very clearly. You just say, I'm not going to trade anything. I don't say I'm going to wait for the pull out of a pullback or breakout. You test moving average at a decent reversal, low test, then take the trade. And very quickly, I want to look at the trade of the yen. So the yen was a little bit different. I didn't get stopped out of yen trades. I want to just show you this very quickly, and then I want to go to a daily chart and show you again leg one, leg two. So with the yen, came into the market, first bar doji, so not convincing either way. And that's whenever you see that kind of doji, it's a trading range. Market went down, went up within that one particular candle. If you go down to a 1 minute time frame, you see a proper trading range. So this indicates that you might get a trading range. So don't jump into any trade. So when I saw that, I said, okay, so that's a trading range that was being indicated here. Now, a couple of things happened. I'll put the height of the trade range just now so you can see that. So the market went up, came back. When I saw that at that stage, I was wondering, is this like a form of a double top that the market is creating, maybe we get resumption or not? But that failed to go anywhere. And the market turned again and gave us another low. At that stage, it almost looked like we have a high and a low and a double bottom. So I'm saying to myself, okay, one of two things can happen. The bears are strong; they will carry on with their breakout. The breakout beneath this, let's get confirmation, and we have a pullback the whole cycle. But that didn't happen. Immediately, we had this inside candle. When you see an inside candle, it's breakout mode. It means the market will break out in one direction or the other. You might get a follow through inside candles, inside, which is an even stronger breakout mode for you to pay particular attention to. In this case, we had a bull breakout, close above moving average, and we had the follow through candle. So I was confident that listen, I can take a trade, but I want to put my stop down near the bottom of this trading range. And let's see if the bulls are going to be strong enough to break above this. So let's put it in this little trading range here. If they're strong enough to break above that, then I think I'd like to take profit somewhere in that zone. So market took off, and that was actual breakout candle. Then I had a follow through candle. Really not desirable. Yes, the bull candle, but I would have loved it to close above the midpoint. So at that stage, I'm not entirely certain that this may carry on. but I'm still in my trade. I'm still holding it. I want to see what happens with the test of that, the test of the 10 EMA. And then had a 2-bar reversal taking place here. And I said, well, you know, I'm gonna take a trade. I'm gonna take that trade. You know, it's a 7 pip. Let's see what I'll get. You know, I might get 1 to 1 or less, but as it turns out, I got 1 to 1 with that. At that stage, I put my stop somewhere down here, 2 pips below. As it moves above that and close above that, I move the stop from this one to here. So if it turned and the stop out from one, I would have saved the money on the other trade. So that's the trade that I took. Now, I want to just jump very quickly to a daily chart and show you something in terms of measured moves on a daily time frame. I'm sorry, in terms of leg 1 equals leg 2 extensions. This is really something that you must pay attention to, and you must start to combine it with your measured moves. So let's just have a look and see what's happening in the market. Where we are currently on the daily time frame here is not a surprise if you understand leg 1 equals leg 2 measured moves. Why would I say it's not a surprise? Because the market moved from here. Okay, I'm gonna delete it again, so that you can see what I'm talking about. If I go to my Fibonacci expansion, there's a leg that started from here, and it went all the way down to this low here. See where this low is? Let's not put it here. And then the market turned and resumed its move, and it went back. It did not close above that, and then the bearish move resumed. So if you are taking a trade anywhere in here, when I say to yourself, okay, I'm going to take a trade, how far do I think the market is going to go? Where should I set my take profit? Now you can see this where the low is, that's moving. That's where that leg 2 would end up after the pullback. So your take profit will be here. But that's not the only thing. The other thing we need to bear in mind with leg 1, leg 2, before you get this second extension, have a look at what's happening here. Okay, again, I want to show you. Let me keep it in. Within this leg 1 here, the market also tends to create a 2-legged move within a larger one. So they are nested legged moves, 2-legged moves, 2-legged moves within a legged move. Okay. So what I've just said is that this whole move from here to here is one leg, which we've marked. Market pulled back and resumed again and ended up exactly at the leg 1 pullback, leg 2 extension. But before you got to that, you'd have noticed something else. Same tool, the expansion. You'd have been in here and said, okay, hang on, I've just come to the market. Market moved to this low. You see this particular low here? Market moved to that low. And then it resumed, it pulled back to that level, and then it resumed its move. So with the leg 1, with the pullback, and how far is it likely to go? Well, it's likely to go to that extent. So if you are taking any trades in here before you had this huge pullback, you would have just taken your trades, whatever strategy that you're trading, put your appropriate stop here, okay, and then just hold. I'm just going to hold and see if I get to that leg 1 pullback, leg 2. This is while you are still in here. And then the market then turns and tests that level. Okay, so if you got stopped up for any reason, like I got stopped at, you take the trade. Okay, it does not matter. You take the trade because random distribution, you do not know which one's going to take. So the market resumes. You might have taken a trade here. You said, okay, I'm going to take a trade here, put my stop here. You have been stopped out there. That's perfectly fine. You take another setup. Now you then say, okay, I've got that leg one. That's one that we marked. Then you wait for how far the pullback will go. If you'd come here and taken a trade, it would have suggested that it would have ended here, and that would have been perfectly fine to set your stop, take profit there. Then you get stopped out. That's fine. You see the market testing the breakout beneath that, decent reversal. Say, okay, so that's possibly my larger leg one pullback, leg two. How far is that likely to go and to give you that level that you add? So confidently, you could take that trade, take another trade, and look to take your take profits there, and you'd have been rewarded. Now, let's have a look at something else. The pullback itself. Have a look at it. You say it's got leg one, pullback, leg two. So nothing is ever linear. So the market pulls back in two legs. Again, you could have done the same thing and said, okay, let me take, there is a pullback. Okay, market pullback to there. And so leg one, I'm talking about the pullback now. Leg one of the pullback, that leg at its own pullback. And how far is this pullback likely to go? Or the pullback might likely get there. So if you had marked the breakout beneath that, and you'd marked where your pullback is likely to get, then the market turns there, you are more assured of taking a trade because you've seen your two-legged move, leg one, pullback, leg two taking place there. So you'll find that if you start to pay careful attention, just look back at a few charts when we are done. At any move, you start to see these two-legged moves. You also start to see your measured moves. So again, if you're taking a trade here, leg one pullback, you would have said to yourself, okay, if the market breaks beneath that, how far is it likely to go? To have come again to almost this exact point. All right, guys, we're coming to the end of this particular show. It's 1 hour. I've enjoyed it thoroughly, and I certainly look forward to catching up with you again next week. Thank you, guys. Absolutely enjoy yourselves and enjoy the trading. Let's have a quick look while we shut down. Okay, no setups have really set up for us on the euro. So break beneath that, so we've got to wait again on the CAD. We're also waiting on the yen. So it's worthwhile to wait because you'll get your rewards. Excellent, guys. Thank you very much, and we'll catch up again same time next week for 1 hour.